Realty Income is often referred to as the gold standard when it comes to REITs. After all, they have coined themselves the monthly dividend company, as they have declared more than 600 monthly dividends, and they have increased their dividend for more than 25 consecutive years now, making them a dividend aristocrat, one of only 3 REITs on that prestigious list. They are popular not only amongst retail investors, because retail investors like that monthly dividend income stream, but they're also popular amongst professional investors, as professional investors see the consistency, the strength of the portfolio, and the strong management team that comes with a company like Realty Income. And because of this, they tend to trade at a premium to their peers. And when you get the consistency and the strength and the consistent operating cash flows that Realty Income does year in and year out, having only one negative cash flow year in their history, that's pretty solid to me. But I am always on the hunt looking for similar REITs that structure themselves very similar to that of Realty Income, but trading at a much more intriguing valuation. That's how I found the likes of Store Capital, which was a great REIT. They molded themselves very similar to that of Realty Income. They focused more though on the middle market tenants, but they got bought out this past year and taken private. But my little plug is, I saw the valuation and I saw how they were building themselves very similar. I got in just before the great Warren Buffett did, who doesn't invest in REITs all that often. But in today's video, we're gonna do something very similar to that. I'm again looking for a REIT, a newer REIT, that is built very similar to Realty Income. And that brings us to NetStreet, stock ticker NTST. In today's video, we're going to combine or compare the great Realty Income to NetStreet, who is the new kid on the block within the REIT retail sector. So with that being said, let's jump into the video. Hey everyone, Mark Rusin here. Again, I am a CPA and not a financial advisor, so everything discussed on this video is for informational and educational purposes only. Please do not take this as financial advice. Also, if you could do me a huge favor and click that like button down below, that is huge for the growth of this channel moving forward. When it comes to investing in REITs, REITs are a great way to gain real estate exposure with a hands-off approach. No need to worry about the broken appliances or the tenant that's late with rent. You just invest in real estate like a stock and take a hands-off approach. But a lot of investors are not that familiar with REITs or companies that are REITs. But when you say the name Realty Income, a lot of investors, even retail investors, know that name or know them as the monthly dividend company. And in this video, we are going to be comparing the likes of Realty Income, the great Realty Income who's been around for a number of years, to the new kid on the block, which is NetStreet. We will compare these side by side. We're gonna look at company overview. We'll take a look at the portfolio, their sector focus, their top tenants, as well as the dividend stats, closing out with valuation. So let's begin with company overview. Realty Income is a retail REIT founded in 1969, and the company went public in 1994. In fact, here's a timeline of the company's success and growth track record over the years. As I just mentioned, the company was founded in 1969. They received an investment grade rating from Moody's, S&P, and Fitch. In 2007, they were added to the S&P Midcap Index. In 2011, they completed their first $1 billion in acquisitions. In 2013, they closed a $3.2 billion acquisition of American Realty Capital Trust, further expanding the Realty Income portfolio. In 2014, they surpassed $3 billion in dividends paid. A year later, they were added to the S&P 500 and the S&P High Yield Dividend Aristocrats Index. In 2016, they surpassed $1 billion in annual rental revenue for the first time. In 2017, they received a credit upgrade to A3 by Moody's, and a year later they got a credit rating upgrade to A- by S&P. In 2020, they officially became a dividend aristocrat for having 25 consecutive years of dividend growth. A year later, they closed a $17 billion acquisition of REIT, making it the first completed acquisition in continental Europe. And last year in 2022, they expanded into gaming by acquiring the Wynn Encore Casino for $1.7 billion. Next, let's take a look at NetStreet and their company overview. NetStreet is internally managed real estate investment trust based in Dallas, Texas, and they specialize in acquiring single-tenant net lease retail properties very similar to that of Realty Income. The growing portfolio consists of high-quality properties leased to e-commerce resistant tenants with healthy balance sheets. NetStreet is a newer company, having been founded in 2019 and went public in summer of 2020. What a time to go public. However, although the company is young, the management team is led by a group of seasoned commercial real estate executives. The company's strategy is to create the highest quality net lease retail portfolio in the country with the goal of generating consistent cash flows and dividends for its investors, something that sounds all too similar to Realty Income. Next, let's take a look at portfolio. As you can see here, Realty Income has over 12,200 commercial properties with an occupancy rate of 99%, almost completely occupied with its property portfolio. The portfolio is leased out to over 1,200 tenants within 84 separate industries. NetStreet, obviously in its early stages like Realty Income was at one point, is much smaller but growing at a fast clip. The company currently has a portfolio of more than 400 properties leased out to 77 tenants within 24 different industries. In terms of international exposure, Realty Income has just branched out into Europe, and something that is very new to them, but NetStreet currently owns properties only here in the US. Both management teams focus on high quality properties, and they want to lease them out to high quality investment grade tenants. As you can see here, 63% of NetStreet's annual base rent is related to investment grade tenants, whereas Realty Income is shown at 33%. But if we take a slide out of the Realty Income investor presentation, we can see that they list themselves closer to 41% for the entire portfolio. Now moving to sector focus. We're diving deeper now into the portfolio, and let's begin with Realty Income, which has a following breakdown. 82% is retail properties, 13.2% industrial, 3% gaming, and other properties rounding out the remainder of the portfolio. Here's a look at how the portfolio is diversified by industry. Grocery stores make up 10% of annual base rent, convenience stores 8.6%, and dollar stores 7.4%. Next, let's look at NetStreet, who is primarily retail, and here's a look at how they diversify by industry and sectors. They pride themselves on having properties that are resilient to economic slowdowns as well as the threat of e-commerce. 55% of their retailers are considered a necessity, 18% discount retailers, 12.4% are service-related tenants, and 14% are other. The top industries include drugstores and pharmacies, accounting for 16.5% of annual base rent, grocery accounting for 13%, home improvement 12.1%, dollar stores almost 10%, and discount retail is 8.4%. These top 5 industries make up nearly 60% of annual base rent for NetStreet. When comparing the two REITs, you can see a lot of similarities in terms of industry diversification. Before we move on to the top tenants for each of these REITs, here's a quick word from today's sponsor. Today's video is sponsored by Moomoo. Moomoo has a ton of great tools for investors of all different levels. And as you may be aware, ChatGPT has gone viral recently. And if you're looking to research stocks in the AI industry, Moomoo's ChatGPT concept feature has got you covered. Simply type in ChatGPT in the search box to access the performance of ChatGPT related stocks. From there, you can head to the specific stock profile page to check out the free and updated short sale analysis, which will give you insight into the market sentiment of a particular stock. Right now, Moomoo has a great promotion where if you open an account and deposit $100, you can snag up to 7 free stocks, including 2 free AI related stocks. And if you deposit $1,000, you could be eligible for up to 17 free stocks. But hurry, this great promotion will only last through the end of March. Make sure you click on the link down in the description below. Now moving on to tenants, where we'll look at the top tenants for both Realty Income and NetStreet. Let's begin with Realty Income. Here's a look at the company's top 20 tenants and their percentage of contractual rent as it relates to the entire portfolio. You can see notable chains such as Dollar General, Walgreens, 7-Eleven, Family Dollar, Walmart, FedEx, Tractor Supply, Home Depot, and Kroger, all high quality tenants up and down the list. Now let's take a look at NetStreet and their top 10 tenants along with their percentage of annual base rent. Notable names include CVS, Walgreens, Dollar General, Hobby Lobby, 7-Eleven, Walmart, Lowe's, Family Dollar, and Best Buy. 6 of those tenants are found on the Realty Income top tenants list, and 7 are if you include or switch out Lowe's for Home Depot. So as you can see, both very similar tenant types and actual tenants that you see between the REITs. One point to make though, that while we're looking at the tenants, is the exposure to each of them. NetStreet's top 10 tenants account for nearly 51% of ABR. Realty Income's top 10 account for only 27.3% of ABR. So it's much less exposure in terms of top tenants with Realty Income than with NetStreet. That has something to do with the size of the Realty Income portfolio, many more properties and many more tenants. However, if you are investing in NetStreet, you want to be comfortable with those top 10 tenants, which as you can see, 9 of the top 10 are investment grade, and the only one that isn't is Hobby Lobby, which is a private company, but they would be investment grade if they were public. Now let's move on to dividend stats. Realty Income pays an annual dividend of $3.05 per share, which equates to a dividend yield of 4.6%. The company has now increased their dividend for 29 consecutive years. They have a 5-year dividend growth rate of 2.9%. In terms of payout ratio, the company has an FFO payout ratio of 75%. Again, with REITs, you do not want to look at the earnings per share payout ratio. And as you are already aware, the company pays a monthly dividend. Now looking at NetStreet, they pay 80 cents per share. They have a dividend yield of 3.9%, and they have increased their dividend both years they've been public. They have an FFO payout ratio of 73%, and they pay out their dividend on a quarterly basis. Now we turn our attention to valuation. Now remember, with REITs, we do not look at PE ratios or earnings per share. We look at what's called FFO or AFFO, which is funds from operation. This is looking more at cash flow and moving back in depreciation and amortization, which is a huge number for real estate. Realty Income currently has a AFFO multiple of 16.4 times. And looking out to the 2023 AFFO estimates from analysts, they are expecting Realty Income to earn $4, which would equate to a forward AFFO multiple of 16.1 times. As you can see on the right, the company has a 5-year average AFFO multiple of 19.4 times. And if I were to expand that out to 10 years, the average multiple is closer to 18.8 times. Nonetheless, shares are trading at a solid discount to their historical value. Now let's look at the new kid on the block with NetStreet. Again, the company has been public for less than 3 years, so not a lot of data to compare to. Currently, shares trade at an AFFO multiple of 17.4 times. Analysts are looking for 4% AFFO growth in 2023, which equates to a forward AFFO multiple of 16.7 times, which is not all that different from where Realty Income is right now. I think analysts are being a bit conservative with their estimates right now because NetStreet is continuing to build out its portfolio and add more properties, which in turn creates more AFFO growth. Looking out at the next 2 years, analysts are looking for AFFO growth of 4% and 5% respectively. But these are numbers I would expect more from more mature REITs. Realty Income, for example, their 2023 AFFO growth is only 2%. So even if those estimates are anywhere close for NetStreet, you are paying roughly the same price for double the growth with NetStreet. Let me first make this point. Both of these REITs are great, and in fact, both of these REITs are in my portfolio. The companies have great management teams, but only Realty Income has a proven track record. So you're gonna pay a premium, you're gonna get slower growth, you're gonna pay a higher premium, but you're gonna get consistent results. You know what the dividend income is gonna be. You know what the results are gonna be for Realty Income. NetStreet, on the other hand, is the new kid on the block. They are growing at a much faster clip, so you're gonna pay the same price, but you're gonna get the opportunity for double the growth. But with that comes higher risk as well. There's gonna be more volatility with this smaller, more unknown REIT. So it's really comes down to what do you need or what do you want for your portfolio? Are you looking for the consistent, slow moving REIT? Then Realty Income is that, because you know what they're gonna be. Or are you looking for higher risk, higher reward, although you already see how the tenant and how the portfolio comes together? Very eerily similar to that of Realty Income, but you're gonna pay the same price, but I think the growth is gonna be much higher for a company like NetStreet as they continue to expand and grow out their portfolio. Down in the comments section below, looking out over the next 5 to 10 years, I want you to tell me which of these REITs you would buy right now. If you could only select one of them, is it going to be Realty Income, the consistency that you're going to get, or is it going to be NetStreet, the new kid on the block that could provide much more growth potential? Let me know down in the comments. And as always, if you haven't hit that like button down below, as I truly appreciate it, and we'll see you in the next video. Take care.